talk about this a lot. One of my commitments to you is helping you grow your family wealth. How many of you guys in the audience, show of hands, have a very clear wealth strategy? A very clear wealth strategy. And how many of you are interested in providing generational wealth for your family? There we go. With that said, guys, I am proud. I talked about earlier about the people that I surround myself with. And we have the honor here today to have one of my mentors, my advisors on the Huffman Family Board, Michelle Mayer. And let me tell you a little bit about Michelle first. Michelle is a top Forbes and Barron ranked advisor. She is number 6 ranked women by Forbes in the country. She is number 1 Merrill Lynch's woman out of 4,000 women in Merrill Lynch. She is number 16 at Merrill Lynch out of 18,000. She's here with us right now. She's standing right over there. She has over $3.5 billion under management. She's a former tax lawyer, Georgetown lawyer. She's a triathlon. She just actually finished the Boston Marathon on Monday, and a mother of 6. Welcome to the stage, Michelle Mayer. She's here, guys.
Awesome. Well, thank you guys for having me. Super excited to be here. Happy to share my words of wisdom with you guys and think about kind of your next step in terms of building generational wealth for you and your family. And I think with a lot of business owners, they focus on their business, right? Because that's what's paramount every day when you wake up. It's staring you in the face, and the focus on the franchise and the focus on how you're going to get through the day with the business. And I understand from talking to some of you last night, like just how overwhelming that can be from the beginning. But the role of an advisor, and certainly my role in working with families, is to take that step back and think about how does the franchise fit within your big picture? How do you get to that next franchise? How do you build generational wealth? And so working with Richie over these many years, a lot of what we've spent our time doing is thinking about the franchise as a piece of a much bigger puzzle, okay? So we'll get started today. Happy to take any questions that you guys have. Would love to make this interactive with Richie and with all of you. So, we live in a really challenging environment where everything's changing every day, every minute, sometimes every hour. The markets are crazy, the economy's crazy, inflation's crazy. And so oftentimes we want to take a step back and think about, what does my plan look like for my family? And in order to do so, in order to really nail this down, you have to create a business plan for your life, just like you create a business plan for your franchise. And so in terms of thinking about where are you starting, right? So that's kind of what's most important today. Understanding where you are. What does your balance sheet look like? What do your assets look like? What do your liabilities look like? If you don't have any liabilities, why not? Should you have liabilities? And planning that out. And so taking a full assessment and an honest assessment about what your financial situation looks like is the first place to start, being honest with yourself. Then talking about, okay, where do you want to go? Today we're in Dallas. I've got to get to Fort Myers tonight to be at a meeting early tomorrow morning. And all my flights got canceled out of Dallas tonight. So a lot of it's me figuring out, okay, I'm here in Dallas. I'm trying to get to Naples. How am I going to get there? What's the direction of my path? And so as you think about your financial lives and the way that I'm thinking about my flight tonight, you have to figure out, okay, here's where I am. Here's my starting point, and that will be very different in the room. Some of you will start with nothing, and some of you are starting, with lots. Thinking about, okay, here's where I am. Here's where I'm trying to get to. I often say, okay, if we're going from Dallas to Fort Myers, we know the direction. We're heading, southeast. And then how am I going to get there? Creating that plan and sticking to it. And so oftentimes when we look at how to create the master plan, It's actually one step at a time. So as Richie said, I spend a lot of time doing Ironman triathlons. And the Ironman itself, that 140 miles competition, is the victory lap of what I do day in and day out to get ready for it. And so building your financial lives and building that plan is really about taking all the individual steps that are actually quite small and don't feel meaningful. But if you take all those little steps and you do it day in, day out with lots of discipline, you get to the finish line and you realize what an incredible thing you've accomplished. But most people just want to jump to the finish line. They want to go out and do the Ironman. It took me 5 years of training to do my first Ironman. Every single day doing something different in order to get to that finish line. And I would encourage you when it comes to your financial lives to do the exact same thing. Create the plan, write it down, every day take one small step to grow big towards your financial goals. Okay?
You want to move a little bit? Let's change it a little bit so you're
Okay.
it's easier on your neck.
Mixing things. See, sometimes you have to change the path.
There you go.
Okay, that's better.
Better.
So there's lots of myths that everybody says, like, okay, it just seems so overwhelming, right? But it doesn't have to happen all at once. You can decide, okay, here's where I want to get to by the end of the year. Here's where I want to get to next year, 5 years, 10 years. Again, it's all about creating the baseline first. Anything is better than nothing. It's kind of like people that say, I want to go on a diet, and then they decide they're not going to eat any carbs. Right? That's a big step for most of us. It can just be replacing, one meal a day. And so when it comes to financial planning, the same thing. Decide what's the one goal that is most important to you today, and how are you going to accomplish that? You can plan for multiple goals at the same time. So for everybody, in the audience who has a goal of opening a second franchise or setting aside the capital to do their first, you can do that and decide on how you're going to, focus on generational wealth at the same time. And then, everybody thinks, oh, it's really too hard, time-consuming, and too costly. I would suggest that not doing it is too hard, too time-consuming, and too costly, because you'll get to the end and you'll realize that you could have taken all the steps with a good advisor to accomplish your goals. Kind of basic questions that you can ask yourself, right? How am I thinking about these? How am I planning for these things? And everybody in the room will have different goals and different objectives. Richie certainly has his own goals and objectives. And this is a process that we go through quarterly to define.
We don't talk about retirement, though.
We don't talk about retirement. No, that's not an option. That's not an option.
Not on the agenda.
No. But creating, okay, what are the things that are important to Richie? How have we done relative to getting to our goals, right? In the same way that you're looking at the P&L of the business, we're looking at a P&L as it relates to getting to the right endpoint, okay? What does a plan do? A plan allows you to go through the cycle of emotions of the market and stick to your guns. If you don't have a plan, you're going to be swayed by your emotions during periods of volatility. And this relates to investing, but it really can relate to any area of your life. It's all about when you're feeling the worst, when you're the hungriest, when you're on a diet and you want to cave. If you don't have a plan of how you're going to get through that or where you're trying to get to, it's very easy to break. And the same thing happens. This is why the rich get rich. So I work with mostly very, very wealthy people. I will tell you the one thing that they have in common is their ability to stay true to their goals and their plan. And when things get bad, they double down, they don't quit. And so the plan, by creating that and putting all that, pen on paper, allows you to get through the cycle. And whether that's the economic cycle, whether that's a market cycle, I will tell you, I've trained my clients during these last month. Nobody's calling me to sell. Not a single person has called and said, sell my portfolio. We're managing $3.5 billion of assets. Somebody would call, but they're all asking, what should we be buying? Because they know what our objective is, and they're looking for opportunity in the markets in order to deploy capital. Right? When you know what you own and you own the franchise, it's easy to say, I know what my asset is worth, and I'm not going to sell my asset at less than fair value. The same thing is true for when you have a portfolio and you own some of the best companies or the best debt. You're able to get through those cycles and stomach it. Okay. Other thing to think about, right? The math says that 50% of 65-year-olds will live to 92, and 1 in 4 will live to 97, and 50% of children that are born today will live to 100. Wow. Crazy, right? So when we're doing this planning, when you're thinking about generational wealth, the good news is, like Warren Buffett, we have lots of time to compound dollars. The bad news is that our money has to last longer to take care of us. So as you kind of look at this chart, you have to think to yourself, okay, how am I going to make this franchise and the other things that are going on in your lives work for me to allow me to have the income, not only to create generational wealth, but to provide for me all the way into my 90s. Okay. Any questions so far? Okay, I'm going to flip through these really quickly. Right. Having an advisor, it doesn't have to be at Merrill Lynch, it could be anywhere. If you want recommendations, just let me know. But having somebody that can guide you in the same way that you're doing so with the children that are in your care. Right.
I think in my experience, guys, this is one of the, when I ask people about their financial advisors, they probably talk to them once a year. We talk.
Do you really want to know?
Yeah, really.
How many times Richie calls me a week?
Yeah.
Probably 4 times a week.
4 times a week to my advisor.
Yeah.
And it's not we're selling, it's how are you?
Yeah. And Richie's a learner, so Richie's always calling and saying, can you tell me why this happened? Why'd the market go down today? Why'd the market go up today? What does this terminology mean? I would encourage you to be learners in that. You know, if there's a term that you don't understand or you hear something in the news, ask.
Yeah.
Ask somebody who knows. And I'm always happy to explain. I love that Richie asked me, you know, what's the inverted yield curve mean? Or, you know, how do I think about the 10-year treasury moving?
Yeah.
What does that mean to me?
Yeah. And on that note, one of her quotes on one of the back slides was, I don't think the market's for me. Right? How do you come up with that? How do you determine that I don't think the market's for me? Because you don't quite understand the market. I tell you, I didn't quite understand the market either, and I don't think I fully understand the market, but I'm a believer in the market. Mm-hmm. And with a really good advisor on my team, I'm well coached and well led in the S&P and other investments that we have. So
yeah, when you own Costco, right? You own shares of Costco and those shares go down 10%. Are they worth any less? No, unless you sell them. You're still entitled to the same share of profitability. Just like for your franchises, when you have a share of profitability, you're able to calculate your forward earnings. Yeah. Just because the market's not pricing that for you every single day doesn't mean that it's worth any less.
Yeah. How many of you guys, just a show of hands, I asked the wealth strategy and the general, how many of you guys are already invested in the market?
Great.
Wow.
Awesome. That's great. And so making sure that you're invested in the markets as individual companies, I'm a big Buffett believer, which is you buy companies that you know and understand, and you hold those companies until something changes as it relates to the profitability or forward earnings. So that's really great to see.
What advice would you give? I mean, because it was like probably 90% of the audience have a financial advisor. What advice would you give them? What takeaways would you give them?
So I think creating the plan and making sure that your financial advisors are giving everything to you that they have the ability to do so. So in other words, a lot of big firms have tools that I'm going to show you, but the advisors aren't giving them to you unless you ask. So make sure that you're asking for the financial advice, you're asking to do the planning, you're asking for their time. They're going to give their time to those people that ask. Or provide them with opportunities. So go ahead and ask for the help to do that planning. Ask for them to build in the franchise, build in the capital that you need to open the next one. Have them help you plan for that, and then just make sure that the asset allocation that you have is something that you can stomach when it goes up and down, but also is geared towards your long-term goals. So again, that goes back to what we said initially. If you don't know where you're going, your advisor doesn't either. So the two of you have to work together to figure out what it is we're trying to accomplish.
Yeah.
put a, you know,
Yeah.
a nail in that and say that's where we're going to.
Yeah. Does that make sense, guys? Yeah. It's like, what does my life look like? What do I want my life to look like in 5 years, 10 years, 15 years, right? And now what's the path to actually accomplish that lifestyle?
And then make sure, you know, with your advisors that they're providing you with kind of all of the solutions that they have. And if you say, well, my advisor doesn't have these solutions, then you need a new advisor. They should be helping you with kind of everything on this page, including, okay, I need some, you know, startup capital for another franchise. How am I going to get access to that capital? Am I going to use a line of credit? Am I going to borrow against my securities? Am I going to take out an SBA loan? Those should be conversations that you're having. And then making sure that, and that's kind of over here under borrowing to fund my goals, right? If one of your goals is to grow generational wealth, it's very hard to do so without debt. You need the leverage, not all debt. I had a call with a client this morning, Rick, that you know really well. Very successful gentleman who sold his company for 9 figures. And I said, I'm speaking this afternoon, what would you want me to tell the audience? And he said, tell them that all debt is not bad debt. He said, because I grew up believing that debt was really bad, that you didn't want any debt. And that's just not true if you're trying to create significant wealth. You want the right kind of debt. And that is debt that's used to buy an asset that's appreciating. You don't want to use debt to go out and, you know, buy a fancy car or improve your lifestyle. But if you're using debt that's backed by a high quality asset, then you'll get an exponential return on your capital over time. And so making sure that your advisor has access to different types of capital. Making sure that your credit cards are working for you. I mean, these are little things, but like, this is what the wealthy focus on. Every one of my clients says, well, what credit card is going to get me the highest return for every dollar I spend? These are things that the wealthy think about. And the answer is, you know, close to 3%. If you're not getting close to 3% cash back on your credit cards, then you need a new credit card. If you're not getting a line of credit that's based off SOFR, right, then you should be talking to someone who can help you get a line of credit that's based off SOFR. Understanding, you know, and there's people in the room here who, and outside, who can help you with your long-term insurance. Insurance for the company, insurance for yourselves. There are people here that can help you set up the 401ks at work for your businesses. And then making sure that you're doing all of the tax planning to keep all of that money you're generating. So many people focus on, how do I make money? But that's not the game. The game is, how do you keep the money you make? Because if you're going out and you're building a business or you're generating wealth and you haven't done the tax planning, basically you're creating a business where the government's at least a 40% partner of yours. Every business that I create, the government doesn't own a piece of it because it's working to make it the most tax efficient. You know, one of the things to think about, and Alan raised this with me earlier, as you think about your business and it generating income, right? That's ordinary income. I think Lou mentioned this as well. That's ordinary income that it's creating. Well, how do you avoid taxes on the ordinary income? You own real estate that kicks off depreciation that offsets that income.
HWG.
Right.
One more plug.
What'd you say?
HWG.
Yeah.
That's what we're doing, right? Every dollar that comes, and just to put this in perspective, guys, I want you to talk about a little bit about how we actually use life insurance as a tool.
Mm-hmm.
Before we get too far, Vakul over here had a question earlier, so I just wanted to give him a chance.
Sure.
Thank you. So you, thanks for this information. This is very helpful. You also mentioned if things are not working out, you change your financial advisor. How do we actually choose a financial advisor? I mean, you Google it and you find millions of, literally hundreds of pages with millions of advisors there. So how do we actually go about and choose one?
Great. A great question. And so maybe I'm a little biased because I'm ranked by them, but I really like Forbes and Barron's. And you can find their lists online. Just go to top Forbes advisors. A lot of people like, my practice is nationwide, but a lot of Advisors have local practices, so depending on where you are, you probably can find an advisor within 50 miles of you who's a top-ranked advisor. They rank, I want to say, 1,200 advisors, and there's something like 400,000 advisors in the country. So you should be able to find somebody. There's a kind of a best-in-state list. I would start there, and I would go in and ask them, okay, what am I going to get for my 1% fee? Because the worst thing that you can do is pay the 1%, and have that be a negative hit on your balance sheet every year, and not have the return be 3, 4, 5% in addition to whatever the markets are doing. Your advisor should be able to give you advice that increases your return beyond the market, beyond what the market would say your normal return would be, and whether that's through credit cards, whether that's through lines of credit, whether that's keeping you from yourself. I often tell people, people say, what's my job? My job is not complicated, but it's very hard. And that's it. I'm the airbag in the crash. But it just so happens, like, I grew up in an environment where I was taught to be a value investor. I like things when they're really cheap. Well, the only way things can get really cheap is for things to go down. And so that mindset makes me a really good investor. I'm a buyer. I bought 50 properties from the banks in 2010 when they were auctioning them off on the steps, right? So you want to have somebody who thinks like that, because maybe you don't. And if you do, great, then you have somebody that's aligned. But you need somebody that's going to say, no, now's the right time to buy. Richie and I have this conversation all the time. I tell Richie, like, here's the number on the S&P 500 that I'm looking to before we back up the truck.
4,800.
Thank you.
You're welcome.
Right? At 4,800, I feel like that's the right number on the S&P when the valuation makes sense. And we've been doing a lot of bouncing in the markets for the last 2 months, and it feels really cheap, but the market hasn't sold off that much. Right? 10% is not a big drawdown. We typically get at least one of those a year. Right? 20%, think about it in terms of, I always say Target.
Yeah.
Like, I don't know
Yeah.
why I picked Target,
Yeah.
but I always say this, like, I'm not getting in my car because Target's having a 10% off sale and driving over to pick up stuff, toilet paper that's on sale at 10%. 20%, okay, I'm interested. 30%, like, let's go. Right? Let's bring the Suburban, get all the toilet paper we need, get all the paper towels, like, we're in. And that's how I think about the markets. And so working with an advisor to get there.
I want to go back to Vakul's question because I think it's a great question. So you say go and there's a whole list, but I also know that a lot of those folks on that list only take certain clients.
That's true.
So I think there's some learning there.
You could ask them. So, some advisors, $1 million, $10 million, everybody has their minimums of who they work with. But you could ask, okay, like, I'll just give you an example. My team, I have 14 people that work for me. Not everybody, like, my clients are 10 million plus because I'm a specialist on the tax side. But I have 3 other advisors on my team that start at 250,000 who are getting the same knowledge, the same investment philosophy, and the same implementation as the 5 billionaires we work with.
So what advice would you give to the families that maybe are below the 250?
So that's a little bit harder, but I would start learning, because the more you learn, the more you realize that you can go out and do this yourself. So you want to have your nest egg, right? You want to fill your buckets. You need to have a certain amount of cash that just gets you through kind of your monthly bills. But anything in excess of that, just look for really high quality index funds, like the S&P 500. Over time, try to put a little bit away into the S&P 500. There are programs, and I know Merrill Edge has one. Somebody was asking about this one earlier today. The police officer from Harford County, wherever he is.
Mike?
There you go, Mike. Merrill Edge has a great program that's free, where you can actually get a advisor at like $10,000 who will tell you, here, it's a CIO portfolio, so it's a very safe portfolio, but it will allow you to at least get started in the market with 0 fee.
Got it. Wow.
So that's one option, but I'm sure Schwab has them, Fidelity has them, Morgan Stanley has them as
So
well.
maybe below, what I'm hearing, maybe below 250, there's programs out there.
There's programs out there that are more like auto programs,
Yeah.
kind of like when you sign up for your 401k at work and you check the boxes of these are the things you're interested in from like a life plan allocation. But if anybody wants an introduction on the Edge side or wants to talk to somebody on the Edge side, which is the free side, happy to make that intro to get started.
Okay.
for there. Any other questions? I thought this page might be interested just to kind of think about, for those of you that have investments, and a lot of people raise their hands, there are programs out there, and it's the two middle programs. The home equity line of credit is the obvious one, but there are two programs out there that allow you to borrow against your portfolio at very inexpensive cost relative to like mortgage rates. So in 2020, I borrowed against my portfolio to buy a house in Florida when I moved there. And I was able to lock in my debt for 5 years. The benefits of using your portfolio as collateral is there's no closing costs. You don't have to disclose anything to the bank. You don't have to kind of go through the whole process of disclosures. And you can pay it off at any time. And the costs are typically lower. Now, it will lock up your assets, but for most of us in here who have shares of Apple or NVIDIA, the goal is to keep those assets long-term anyway. So that's, I just want you to know that those programs are out there. They're available to everybody. There's no minimum, as a good way to gain some capital to do some of the things that you all want to do with the franchise. And then margin lending, which is typically more expensive. I actually wouldn't go that route. The loan management account is the less expensive way to get the debt. And you typically, just to kind of give you a sense, be able to borrow 65% against your equities and about 80% against fixed income. Okay.
Do you have a
Every
question?
one of my clients.
Sorry, I do have a question out here.
Yeah, please.
Hi, Michelle. This is Irfan Tajani from Houston. If we borrow against our portfolio, so you mentioned 65% of the value, does that value change based on the values of the stock?
Yes.
And then the second question is, do we pay any fee or any interest against that borrowing?
Yes, so the answer is yes, yes, and yes, which is the 65% is driven off the fair market value of the portfolio on a daily basis. So I always tell my clients, whatever your LMA, and Richie and I have had this conversation, if your LMA is $100,000, don't borrow more than 50. Because the last thing we want to do is have a capital call, meaning we have to like sell stuff to pay it down. So we want to give ourselves a lot of room. So if you needed to borrow $50,000, right, you would probably want $120,000 in the account to borrow the $50,000. The rate is typically somewhere in the neighborhood, like in today's environment, anywhere, depending on how much money you have, of like 5% to 6.5%, which is far less than the cost of margin debt or a mortgage or any other commercial financing, and there's no costs associated with it. And you only pay when you use it. It's like a credit card. It's like a really low-cost credit card.
So in that event, let's suppose if a portfolio is making 8% return and I'm borrowing it at 5%, so my net is 3% gain on the portfolio, and I can have this readily available as a line, so it's for me to withdraw whenever I want. I don't have to withdraw it as a loan if I don't need it.
You could take the money out. I mean, you're creating a positive arbitrage there. The debt itself is tax deductible, so your true cost is probably closer to 3%. So you're actually picking up a 5% spread if you have something to write off the debt against. Does that make sense?
And last question, sorry.
It's okay.
Is there a way to optimize your portfolio to achieve 10% or more return over the year?
There's a couple ways to do it. So yes, obviously higher risk, higher reward. If you don't need liquidity and you look at kind of returns over time, let me see if I have this page in here. I do. If you look at returns over time, kind of the highest return assets are at the top in any given period of time. You typically will get about a 10% rate of return in US large cap stocks over time. You'll also get a 10% rate of return in private debt as well. So these are companies that are lending your money to large private equity firms to go out and buy other companies. It's really hard to get that in fixed income other than through private credit. But a diversified portfolio, you can kind of see over time, the white is the diversified portfolio, which steadies the return. Diversified portfolio will typically be about 8%. But what's really important is not only to think, okay, I want to make 10%, but how do you keep that 10%? Because you can get fixed income and private credit that's paying you 10%, but it's subject to ordinary income. So if you're in a 37% tax bracket or you live in a state with high state income taxes, you could lose half of that easily to the government. So I prefer things that aren't quite as tax inefficient. So master limited partnerships, which are oil and gas pipelines for all of you from Houston. Companies like Energy Transfer, Enterprise Product Partners. These are companies that pay close to 8% dividend tax-free because, like real estate, the build out of the pipelines is treated as depreciation. And all that means for those of you that don't understand is basically they're building pipelines, more and more pipelines, and they get an offset on their tax return for the build out of those. In the same way when you buy real estate, you get it depreciated over time. So that 8% comes to you tax-free.
And I promise last question. So whatever the earnings are, let's say 8% or 10%, we could withdraw that monthly, or does it have to get reinvested, or is it delivered to us upon request if needed?
You could do, yeah, I mean, any kind of investments over time, you can sweep all the income that comes out, you can reinvest it. What I often tell clients is if the underlying asset is up, then maybe we don't reinvest at a given time. And if the underlying asset is priced down, so like Energy Transfer as an example is a stock that I've been invested in for 15 years. That stock was trading at $22 2 months ago. It's trading at $17.50 as of today. Today is a great time to be reinvesting those dividends rather than pulling them off the top. Bank of America has a $23 price target on the stock, so we're still trading under, but that's a good company to be reinvesting in. So the decision is yours to make.
Thank you so much.
You're welcome. Okay.
Any other questions while we're taking them?
So I want to show you kind of an example of what a plan would look like, and we can go through this really quickly. And they're all made up numbers. But what I want to show you is for a client who basically says, you know, I need $300,000 a year to live. I'm going to retire at 2038. I've got 2 kids going to college. Super expensive to go to college. Apparently $200,000 a year. I messed that number up. Should be like $100,000 a year. But maybe they're going to Harvard Business School. And then a vacation home purchase. If you don't write it down, you won't make it happen. Right? You have to know what you're trying to do. For this client, we were able to say, and here, just to give you, here's their assets that we had. They had $1 million in personal assets, $1.8 million in retirement assets, investment assets of $570, the value of their franchise. We had Celebree income, salary income for the non-owning spouse. We had the goal to maximize 401k, maximize the spouse's IRA. And what you'll see is we were able to model this and say, okay, what's the likelihood that we're going to accomplish those goals that we set, right? Based on the spending that we had. And what does our wealth look like over time? Now, this is complete garbage in, garbage out. Right? I threw this stuff on here just so that you could see it. If you were to see mine, it has about 30 goals on it. You should see Richie's, it has a ton of goals on it. And we model this out, and Alan will tell you, Alan calls me every quarter and says, how are we doing relative to our plan? Okay.
But this is something, again, that your financial advisor should be helping and
if they're not, we're happy to do it for you, but this is kind of the information that you need. This is your plan. How do I get from here to there? And it's all math, but it's only as good as the inputs that you have and what your goals are over time. Okay. This will also help with some of the other things we talked about, which is how do you give money away to your children? How do you know that you have enough money to give away to your children? How do you know that you have enough money for yourself? And in this case, you can see we had a very aggressive asset allocation that was funding a lot of this lifestyle. But if I go towards the back here, right? If I ran it as a conservative allocation, they're actually underfunded. So this is the information that we use to basically say to the client, I know this is painful. I know drawdowns are painful, but it is part of the game. The smart money buys at the bottom, the dumb money sells. And the key with all of this is you don't want to be the dumb money. I tell my clients all the time, we are the smart money. We are the ones that buy. We are not the ones that sell assets at low prices. And the only way to become the smart money is to understand what you own and why you own it. And when you have a plan, it allows you to say, okay, we have a long-term goal here. Okay.
That's another great question, and I ask this question all the time to people, even those that have financial advisors. Do you know what you own? How many people know what they own in those portfolios, right? It's a very small number, guys,
Yeah.
right? They just trust that their financial advisor is making the right decisions for them. But when you ask them, what do you own? I'm just like anything else. If I asked you what you own, you could tell me I own a car, I own my house, I own this. You could tell me everything you own. But when it comes down to this and stocks and fixed incomes, most of our people that I know couldn't even tell you what they own.
Yeah. Well, I'd say the biggest mistake that I see with clients' portfolios when they come to me is that they've had a 401k at work, and they log into the 401k website and they click the retirement age, right? They have these balanced portfolios that get more conservative as you get closer to retirement. But if you're somebody that doesn't need that 401k to support your lifestyle, the time horizon of that 401k is a lot longer. And so you want to be in that's the last assets you're going to touch. You want that to be the most aggressive piece of your portfolio because the government's subsidizing the growth. You don't want to have that portfolio be, de-risking as you get closer to 65 or 70. I think that is it.
Any more questions, guys? Carl?
Yeah, just wanted to clarify, you mentioned you talk 4 times a week, that feels a little bit too much to me. I'm sorry, Sam. All right, so, and then I heard annually also, Richie, I think you said, and I think I heard quarterly.
Yes.
Because admittedly, I'm somebody, I talk to my person about, actually I have 2. I talk to them each once a year and I compare what they tell me and then I decide what I'm gonna do. But help me understand, what is a good frequency? Because I actually
I
hadn't
prefer
thought
every
about it.
3 months.
I'm sorry, can you
Every
say that?
3 months to every 4 months. So 3 to 4 times a year. Now, Richie and I are friends and have developed a friendship. So and Richie's always interested in understanding what's going on and learning. So he'll shoot me a text like, what is this? I'll pick up the phone, we'll talk.
But the real value out of, Michelle is not, she is much more than just the very typical financial advisor. I mean, she's in a class by herself, I believe, with her background of tax knowledge and being a tax attorney. She is an advisor to the family. So every quarter when we sit down, we are going over our family wealth strategy as we talked about. And that wealth strategy includes business, it includes real estate holdings, and private equity, private credit. So we are talking, Michelle's a piece of the overall discussion of the entire wealth strategy itself. So, and I want to make sure that you guys just don't think that's only for Richie. No, that's for your family too. Trust me. That's what I want to get. This is the value that I want to bring to you guys, because I know every single one of these every family in here wants to create wealth for their family. Now, we all might be at different stages of that creation, but even if today's just planting that little seed today, I want to help that seed grow throughout the years as we're franchise partners together. But the quarterly meetings, we have Alan as our CFO in there. We have our trust attorney that's in there. We have Michelle. We have our tax people that are in there. Insurance, and we're talking about how are we growing our wealth towards the strategy that we've put forth? Are we protecting it? And are we thinking about the future of the strategy itself? And for me, it's all about the generational wealth.
You have to ask to have that frequency, right? You need to basically, think of it like a coach. Like having a coach that says, here's your plan for the next, year, and you don't check in at all, how that's going, whether things should be tweaked. Things are changing in your life all the time. And whether that's income from the business or the capital needs of the business or a child that has, excessive needs, all of that's changing. And to pretend like none of that's happening, if you have a coach that doesn't have information on what's going on in your life, how are they possibly going to be a good coach to you? And maybe, you know, part of that's you that's saying like, well, I'm not giving them that information. I'm checking in and deciding what I'm doing. I would suggest to you that maybe you don't have the right coach for you in terms of somebody who's your partner rather than somebody who's just executing for you.
Yeah, hey, Michelle, I'm going to take that question a little bit in a different direction, Carl. So you're taking the pulse once a year. Michelle's talking about checking the allocation 4 times a year. And so we don't always change the allocation, but we're checking in on a quarterly basis to make sure that it makes sense. What are market conditions telling us about, you know, changes we should be making in the near term or thinking about? So, you know, I think, Michelle, you're the expert, but, you know, doing an annual review is important, but checking in on a regular basis to make sure allocation still makes sense, I think is important. Is that where you were going?
Yeah, I think of it like Waze, right? When you get on Waze and like it's updating your route, like lifetime, like that's what my job is, to update that route. Everybody can say like, oh, you're in Dallas and you're trying to get to Fort Myers, here's the quickest road. But what happens when a tractor trailer overturns on the highway? How are you gonna reroute? The advisor is there to help you reroute, to get back on track, because things will happen.
But we, in the last 5 years or 1 year, we really have never.
We've made very slight changes.
Exactly.
But a lot of it's just understanding how this piece fits in, and like for all of you, how the liquid piece fits into all the illiquid assets that you're doing. So the financial advisor their piece might not be changing, but the whole picture might be changing. The access to credit might be different in terms of what you need. You might need a new credit card. We have clients who, you know, are paying the medical and educational expenses for their children. Well, the more conversations you have where the parents tell me that they're not paying those expenses, I'm like, wait, we need a solution here. We'll give the kids a credit card that the parents pay, and we tell the children, and when I say children, I mean kids in their 30s who have children themselves, pay for all medical and educational expenses with this credit card. Mom and dad will pay it. Everything will be recorded. We're trying to solve for all those problems. It's like going to the doctor and saying, you know, here are my symptoms. And the doctor says, okay, you know, I'm glad you're on a healthy diet and you're doing, you know, taking all your medicine, but here are some other things that you should be doing in addition based on those symptoms.
Okay.
Any other questions?
Oh, yeah, so kind of
you.
thinking about, I mean, everybody has their own opinions about insurance. Certainly, when you have illiquid assets that are harder to price, if you have a taxable estate or you could potentially owe inheritance tax, having the liquidity that you need for insurance makes a ton of sense. So, you know, like I'll give you an example. In my personal life, the value of my business would make it a taxable estate. We have insurance so that as long as I'm working, that the family won't be forced to come up with a tax bill very, very quickly. And so the insurance builds that in. You have little children, they're gonna have, you know, while you're still growing the business, while you're building to that generational wealth, having the insurance as the gap during that period of time makes a ton of sense. Because anything can happen, sadly.
Especially for our young families, it's so dirt cheap, and it's instead of dipping into your liquidity and having to pay these tax bills or leaving your family to pay these tax bills, you know, you bought a $5 or $10 million life insurance policy that takes care of all those obligations for the family, and then your wife and your children get to keep the assets that you've created.
And it allows you to take risk, a little more risk in your life than maybe you otherwise would, because you'll know that if something happens during that period of wealth generation, that your family will still be taken care of.
So guys, my goal of today was just to plant these seeds with you. Go back to your financial advisors, ask these hard questions and see how they respond. I think Michelle's spot on. I think most of them have the answers. They're just, for some odd reason, I don't know the answer, they just don't give them to us unless we ask. So let's go back and let's ask our advisors that we have these tough questions and ask them to help me build my wealth strategy. And it should not include just, you know, the stocks and bonds and fixed incomes. It should be everything. It should be, and our family, you know, our 3 pillars of wealth creation is you know, the 3 most important pillars. It's business, it's the stocks and bonds portfolio, and it's our real estate to offset the taxes. So Hopefully today was helpful. I know this could be a little like glazy over a little bit because
come
we're talking
on.
about numbers, but this is our commitment to you guys. We want to pour into you and help you build wealth for your family. So Michelle, thank you.
I wanna be a billionaire, so freaking